the Autumn Budget 2024. In this video, I've designed it for people who I speak to all the time, my clients. So for small businesses, for the self-employed, for landlords, for people who've got a bit of money and need to do a tax return. I'll go through each of the main areas of change in the budget, and some of them I will need to do a separate video for because there is actually quite a lot in there and too much for just one video. So I do regular updates on tax and accounting issues, so if you want to be kept up to date, then please subscribe to the channel, and if you press the like button it does help me in the channel, so thank you for doing that. So we may as well start with the big things. Well, first of all, actually it's a draft budget, so this is draft legislation. Doesn't mean it'll go all the way through Parliament. If the government gets into a corner with something, they might change it, but when they've got a 200-seat majority they can actually do exactly as they like. So the first thing is the national insurance and the minimum wage. So this is a big deal. It's a big deal for small businesses. So there's a number of elements to it. So we all know that the national insurance for employers is going up by 1.2% to 15%. Also within that, the allowance before you pay national insurance is increasing from £5,000 to £10,100. So you do get a slightly larger allowance, which will help very small businesses. But within that, they're also increasing the amount of income that is subject to the tax. So it's, at the moment you pay national insurance, employers national insurance on everything over 9,100. That is going down to 5,000. So you'll pay national insurance on an extra £4,100. So that's just over £600 per employee. So the extra allowance effectively means you have 7 employees free, but then you also have to pay the 1.2% extra tax. These are big numbers. It's a lot more tax that will be paid by small businesses, and it's coupled with big increases in the minimum wage, particularly for younger employees. So these are going to be big costs coming through, and it also affects your differential between minimum wage people and other employees, so that will ratchet everything up. Those are big costs. And within that also, when you start making your pension payments for employees, you make them linked to when you pay national insurance, so you'll also have to pay your 3% on an extra £4,100, so that's an extra pension cost. And of course your employees will pay their 5% pension on that 4,100 extra, so they'll actually see, with all this, they'll also see a reduction in their income because they'll be paying more into their pension, but their pay slip will look a little bit smaller, and they might notice that because the government has been very clear that people will not be, individuals and pay packets will not be taxed more. But when they see that, the pension, does it feel like a tax or does it feel like a pension payment? I don't know. So those are big changes. The next change is with stamp duty. So there's been some tightening around stamp duty, but the big thing is that the supplement that you pay when you buy a second house is going from 3% to 5%. That'll affect us in a number of ways. First of all, it'll mean if you're a buy-to-let landlord, you'll want to own the property for a very long time to be able to write that 5% off over a very long time, and that's probably behaviour that the government intends. But also, if you buy a house before you sell your existing one, you'll have to fund that 5% while you sell your previous house. That's quite a lot to do as well. And it means that landlords will have to fund a lot more costs, because they're now going to have to pay the normal stamp duty, the 5% surcharge, all the costs associated with buying the property, and the deposit before they can get a mortgage. That's an awful lot of cost, and it will, I would imagine, deflate the buy-to-let market quite a lot. And I guess that's to some extent the intention of the law. But it does make it very difficult for landlords, and I guess I actually think that is their intention. But it might also dip the capital values, particularly because the budget has been received by the market in a sort of negative way, because sterling has gone down, so inflation will go up, and UK interest rates from the government bonds have gone up. So the markets are demanding a higher interest on government bonds because they think that this budget doesn't, because they know that this budget requires a lot more borrowing. So capital gains tax, it was long trailed that capital gains tax was going to increase, and in the end it's only increased somewhat. So the capital gains on selling properties has stayed the same, so the reduction from 28% to 24% that the last government did right at the end has stuck, and it's still at 24%. The rate on properties at 18% for a basic rate taxpayer is the same, but the rates on stocks and shares or anything else is increasing. So it's increasing from 10% to 18% for a basic rate taxpayer, and from 20% to 24% for higher rate taxpayers. And 10% to 18%, they sound like relatively low tax rates, but obviously that's an 80% increase in the tax you pay as a basic rate taxpayer. It's an awful lot. But not as bad as you thought. And actually I sold some assets just before the budget to crystallise again and pay the lower tax, and it sounds like I might not have had to do that just for a 4% change in the tax rate, but there we go, you take your chances. I think the more important for small businesses though is the changes to entrepreneurs relief. So entrepreneurs relief, you remember, is that on the first £1 million each individual sells their business for, they get a reduced rate at 10%, not regarding the high rates of tax. That is going up from next tax year to 14% and then to 18%. So that's quite a big, so again, entrepreneurs will pay 80% more tax. And the saving compared to the main rate is really quite minimal, because now entrepreneurs pay 18% tax, and the normal rate for everything else, if they're a high rate taxpayers, is 24%. So there's a 6% tax saving. So certainly nowhere near as much as it used to be, but there we go. I think that's quite a big change for entrepreneurs who are looking to sell their business. Just a little point on double cab pickup trucks. Looks like they're going to be treated like cars. With the last lot, there was some case law to say that they were cars because the revenue took it through the courts. Then the government said no, it isn't, and then this lot say that yes, it is a car. So there you go. So if you're looking to buy a pickup truck, you might just want to think about the tax consequences, because they may change over your period of ownership. But we'll see again when we see the fine print of the legislation as to whether that is the case or not. There's some big changes to pensions. So if you remember, the last government got rid of the lifetime allowance, which was a total amount in your pension pot, and if you had more than that, you had this 55% tax. So they got rid of all of that, and they got rid of it because doctors were paying a huge amount for their pensions. They didn't reinstate it because it affects doctors and if I'm going to be cynical, MPs and senior civil servants. So they've still got rid of that, but it's sort of self-policing now. So if you got up to £1 million in your pension, you still get your tax-free lump sum. So if you put money in, you're saving higher rate tax, and then if you're a basic rate taxpayer in retirement, you're going to pay 20%, but you get your tax-free lump sum. So the effective rate tax is 15%, because you get 25% tax-free lump sum. If you've got considerably over £1 million, then you don't get your tax-free lump sum on any more money. So then you don't get a reduced 15%. You're paying 20% tax if you're a basic rate taxpayer. But if you think this through, if you've got loads more than £1 million, and you've got a choice, if you die with it, they take money away in inheritance tax, which means that you pay 40% inheritance tax, and then probably your heirs need to take it out as income, and they maybe pay 40% as well. So the overall tax take is 64%. Well, that's no fun. Or if you've got well over £1 million, then you're going to have to pay high rate tax when you take it out of your pension scheme, and then you pay 40% tax. So that's not so much fun. So it's sort of a buffer on, and it depends how young you are, how long you expect to live, what sort of interest rate you're expecting, but there is a sort of soft buffer on how much you want in your pension scheme, and I'm going to discuss this in greater detail in a specific video on this area. And it is part of a general tightening in inheritance tax. And again, the papers, they really picked up on family farms, and we'll see if that actually gets through from draft legislation to actual legislation, because the government's taking a lot of heat on it. But also, if you've got shares in AIM listed companies, so if you've got a family farm, first million, then you don't pay inheritance tax, and then you pay inheritance tax. Now that £1 million is not a transferable between husband and wife. So if your spouse dies, you don't get 2 million if they leave the farm to you. So it's an individual allowance. It also affects, which I don't think has been quite as well recorded, if you've got shares in AIM listed companies. At the moment you get business property relief. You'll get it at the reduced rate, so you'll still pay 20% inheritance tax. So a lot of inheritance tax planning went on about buying shares in a portfolio of AIM listed shares. That's still partially, it only half works now basically. And if you've got a large family business that's worth over £1 million, don't forget it's £1 million for each spouse, but they can't inherit it. So if your spouse dies before you, you don't have £2 million. Each spouse has £1 million. There's a bit of planning involved in that, and we'll see actually whether that gets through Parliament, because the government is taking a lot of heat on it. So I wouldn't panic just yet on the family farm issue. But again, as with pensions, I think the inheritance tax landscape has actually changed quite radically, and I want to do a separate video on that. So what we've got is some big increases in national insurance, big increases in minimum wage. That's going to have a huge impact on small businesses. There's some increases in capital gains tax, which I don't think are all that bad. There's definitely tightening of the rules on pensions, which, to be honest, pensions were never designed to be inheritance tax vehicles. There's tightening of the rules around inheritance tax and on business assets. All of this means that we need to plan a little more carefully, and we need to work out how we do our pricing given the huge increase in costs. We're always here to discuss these things with our clients, so if you want to get in touch, then please do. I will be doing separate videos on each of these the important areas here. So if you'd like to subscribe, then please subscribe to subscribe. If you'd like to hear them, please subscribe, and if you press the like button, it does help me, so thank you.